Hey bro, I heard you buy options. Don't play this game really. My friend best friend some more, buy GameStop call options. Lost all his money, become bankrupt. Wife left him, kid left him. Now can't even find girlfriend. Last I heard want to go all the way to the top floor and jump down. I had to stop him.
Before I started embarking on my options learning journey, I had friends and family members warning me on the dangers of options. They were always telling me to be careful of it and how they know of friends being burned and losing large amount of money playing options. However, each time I go online, I keep seeing people flexing their gains such as these. So who is right? Is buying options as dangerous as what it is made out to me? Or have I accidentally stumbled upon the fountain of wealth? Today, I am going to show you everything you need to know about call options so that you can make an informative guess as to whether calls should play an important part in your investment portfolio and the risks involved in buying options. What's up everyone, Darren here. So most of my friends, they know me as the Birdman or the guy with too many kids. But what many people don't know is, yes, I seriously love birds, but I love options even more. Okay, that definitely did not sound right. In fact, I have been crazy over options since 2008, and I would like to use YouTube as a platform to go through what I have learned over the years, as well as share various option trading strategies, trade execution videos, and also trade journals where I reflect on particular trades that I have made and how I could have improved. Before I begin, let's be honest here. Options are definitely risky if executed wrongly, and one can potentially lose more than what one puts in. Therefore, if you are new to options, do yourself a favor and research about options first via videos such as this, as well as paper trading first before placing real money to trade. So these will be the topics that I will be covering. What are options? Types of options? Why do people trade options? Why do people even buy call options? When should you buy a call option? A simple way I use to stack the odds in my favor, position sizing, and I will end off with an example of a successful call option trade. However, before I begin, I'm going to give you guys some time to smash that like button and subscribe to this channel while I take a sip of water. So what are options? An option is just a contract that gives the option buyer a right to either buy or sell an asset. In our case, the underlying asset is a stock, and we can buy or sell that stock at a fixed price, which is also known as a strike price, on or before a fixed date, which is also known as the expiration date. I'd like to simplify this with an example. So let's meet Jane. So Jane here thinks that Apple is going to skyrocket by next year. Jane can then go to the stock market and buy 100 Apple shares at the current market price of $160. Alternatively, Jane can also go to an option broker and buy a contract that allows her to buy 100 Apple shares at $165 for 1 year. And because Jane is buying a contract, she needs to pay an upfront fee known as an option premium to the option seller. Now let's fast forward to 1 year later. If Apple were to go up to $200, then Jane will have the option of buying 100 Apple shares at $165, and her total profit will be $200 minus $165 and minus the upfront fee that she has paid. However, if Apple were to remain below $165, then Jane will be better off just buying her Apple shares from the stock market. In summary, there are two types of options. There is a call option and there is a put option. Now when someone has bullish vibes, aka they think that the stock is going to the moon, they can buy a call option. This is because the call option premium, which is the amount that the option is worth, will tend to increase when the underlying stock price increases. However, if someone has bearish vibes and they think that this stock is going to crash and burn, then what they can do is buy a put option. This is because for a put option, its premium will tend to increase when the option's underlying stock price decreases. Everyone good so far? Okay, so with this in mind, what are the practical uses of options? Well, with the right option strategy, one can achieve profits when the stock market goes up, when the stock market goes down, or even when the stock market remains neutral. In fact, you know sometimes when you go on Facebook, you can find paid ads saying stuff like this.
Do you want to earn money when the stock market goes up, when the stock market goes down, and when the stock market goes sideways. Join my free webinar and I'll train you for free.
And these are all generated via options. In fact, when I started learning about options, it made me more and more interested in the topic and how to execute the various option strategies out there. Now let us get to the main topic of the day, which is why buy a call option? Why not just buy the stock up front if you are so bullish on it? After all, you can hold the stock forever and ever and ever. You get the point. But for an option, it has an expiration date and you can lose every single cent if you run out of time. In order to answer this question, we have to first understand that one option contract controls 100 shares. Therefore, buying a call option gives us leverage. I know for many, just hearing the word leverage should send red flags and warning signals, but hear me out. Let's say you are bullish on this whole metaverse thing and you feel that it's just a matter of time for Facebook to fly to the moon. You can decide to buy 100 Facebook shares. Let's say Facebook is trading at $303.17 right now. 100 shares is going to cost you $30,317. So, if Facebook goes up by $1, your position will go up by $100. Easy, right? If we were to divide the profit of $100 with the initial cash outlay, then your return would be just $100 divided by $30,317, and that will work out to 0.32%. Okay, now let's say we were to buy a 1-year call on Facebook that expires on the 20th of January 2023 with a strike of $305. The amount that you need to fork out for that one contract would be $4,525. Okay, wait, Darren, this is getting crazy confusing. How do you get $4,525? Remember I told you that one option contract controls 100 shares? Hence, in order to get the total premium, you look at the asking price, which is the price that the option is being put for sale right now, and multiply that by 100. So in this example, that would be $45.25 times 100, which equals to $4,525 per position. So how much will we earn if Facebook were to go up by $1? For that, we will have to look at the options delta. The delta roughly tells us how much an option price would change when the price of the underlying asset changes. Let us now look at Facebook's delta. You can see that the call option on Facebook, which expires on the 20th of January 2023 with a strike of 305, has a delta of 0.5655. This means that if Facebook were to go up by that $1, then theoretically speaking, your option price will go up by 0.5655 times 100, which equals to $56.55. So let's say instead of forking out $30,317 to buy 100 shares, we decide to just buy one option contract that controls that 100 shares. Then if Facebook were to go up by $1, our profit will be $56.55. Therefore, in percentage terms, that would be $56.55 divided by what we paid for the contract, which is $4,525, and that would be 1.24%. Hence, if I were to divide this 1.24% by the 0.32% that I would get by just buying that 100 shares, I would earn 3.875 times more by buying a call as compared to buying the stock. Wow, does this sound like a good deal? I mean, if someone were to tell me this in the past, I might just have taken out my life savings and bought a bunch of calls. I mean, what is the point of buying stocks already? Well, there is a flip side to this story. If we were wrong regarding Facebook and it ends below the strike of $305 on the option expiration date, then so sorry for you guys, it's game over. We will not get a single cent from that position. Hey, but wait, don't leave just yet, okay? Imagine if Facebook were to indeed tank, the option buyer would just lose the premiums placed in the trade. Let's compare this to that poor person who bought 100 Facebook shares. If Facebook were to tank, his capital of $30,000 would be stuck. And should the stock keep dropping, then it really sucks to be him, don't you think so? Hence, another advantage of buying call options are, it allows you to limit your risk in the event a trade goes against you. Okay, enough about the advantages. Let's go through some disadvantages of buying call options. As I mentioned earlier, options magnify your gains. Hence, it also magnifies your losses. Another disadvantage of buying options are, they lose value over time because there is that expiration date. Stocks, on the other hand, do not have an expiration date. And also, as the owner of a stock, you get to receive dividends, whereas the owner of call options do not receive any dividends. So when should you buy call options? In my honest opinion, I would only consider buying a call option when I am very, very bullish on a particular stock or ETF. This is because when you buy an option, you first have to pay its premium. Therefore, your break-even is a strike of the option contract plus the premium. Let us use Facebook as an example again. Let's assume we bought the call option that has a strike of 305. The asking price was $45.25. This means that our break-even is 305 plus $45.25, and that equals to $350.25. Hence, when you were to buy this call option, you have that level of conviction that Facebook would definitely remain above $350.25 on the 20th of January 2023. And if you feel that you'll never reach that level, then please find another stock or implement other option strategies. In fact, if you guys want to know other option strategies, just type in the comments below on what strategies that you are actually looking at, and I can consider covering them at a deeper level in later videos. Okay, now that I've gone through the basics of what you need to know when buying a call option, let me share with you guys on some ways that I personally use to stack the odds in my favor. I do this by using my paid technical screener called marketclub. So basically, a technical screener is a screener, that finds bullish and bearish stock for us without us needing to spend countless man hours scouring the entire stock market for bullish or bearish trades. As the busy individual that I am, with one wife, 3 kids, and a full-time job, I honestly have no time to look at charts and find that good setup. All I need to do is enter the Market Club homepage, click the top options section, and sort between bullish and bearish trades by clicking the score button over here. And boom, it's done. So how do I stack the odds in my favor using Market Club? I'm glad you asked. Firstly, I'll only place an option trade in the same direction as the general market, which in this case refers to the big 3 indices, namely the Dow Jones Industrial, the Nasdaq, and the S&P 500. Hence, if the 3 big indices are not giving me bullish signals, then I'll rather not buy a call option and just Netflix and chill. Next, I'll evaluate the trend of the stock. I do not want to enter a position where I'm against the overall trend of the market, because I firmly believe that the trend is your friend until it ends. How do I check the trend of a stock? This is done by clicking this button over here, and the trend analysis will appear. I will normally also look at the stock charts just to give me a general feel of the stock. And lastly, I will tighten my stops when Market Club gives me a red weekly or red monthly trade triangle, and that will be my exit signal. For those who are not sure what a stop is, a stop in this case is an automatic order that will sell our positions to the market when the option drops within a certain price. We use stops to prevent holding on to losing trades and to keep emotions out of the trading game. Please type in the comments below if you guys also want a more detailed introduction of Market Club. I'm more than willing to make a video on that. And if you guys are keen to explore Market Club, I have an affiliate link down in the description below where I receive compensation for each sign up at no extra cost to you. All signups help keep this channel running, and currently Market Club has an ongoing promotion where it just costs you $1 to try the service for 30 days. I think it's also fitting that I talk a little bit about position sizing. You know, the market is like this one big casino, and this is how it works. You go to the casino, you place one small trade, and guess what? You earn. Then you're thinking, wow, this is just too easy. Why did I even bother spending so many years getting that degree? So you place another small trade, and guess what? You earn even more. That's where some of us start getting crazy and just bet the whole house on the YOLO trade and burn our whole trading account and come to the conclusion that
I tell you already, don't play with options, confirm lose money one.
The whole idea of position sizing is that regardless of your trading account, we always place a fixed small percentage per trade. Therefore, if we were to lose in that position, we will still have enough tokens to play the game. Yes, you heard me right. I like treating the stock market like a game so as to take my emotions out of my trades. For me, I like only risking 2% of my trading capital and having a maximum of 5 open trades at any given point of time. Position sizing is a whole topic by itself, and I don't want to deviate from that original topic. With that in mind, let's go through a case study of a Microsoft call that I had placed last year. On the 10th of June last year, I purchased a Microsoft call that expired in 509 days. This is also known as a leaps option. As you can see from my order, the option contract costs $28.30, and this total trade cost me a total premium of $2,830. Now I placed a stop at $78.30 and my trade was automatically stopped out at $76.80 on the 10th of November. Hence, this is the breakdown of my profit. I got back $7,680 from the trade and my original cost was $2,830. Hence, my profit was $4,850. This is a return of 171% in around 5 months. Not too bad. For those who are keen to know a passive way of investing, then do check out my SPY Leaps strategy where I show how I invest in the SPY via Leaps, which has netted me a 100% win rate for the year 2021. And if you found value in this video, please do me a favor and like and subscribe for more options related content. Peace.